My name is Ron Feldman. I'm the Senior Vice President for Supervision and Regulation at the Federal Reserve Bank of Minneapolis, and I'll be talking about banking conditions in the 9th Federal Reserve District in 2010, as well as our forecast for banking conditions in 2011. Before I do that, let me give you a little background on the Federal Reserve's role in supervision of banking institutions. We supervise two kinds of institutions. One are called state member banks. These are banks chartered by states that are members of the Federal Reserve System, and there are roughly 80 of those in the district. We also supervise roughly 600 bank holding companies. These are firms, just as the name suggests, that own a bank. We supervise them in two regards. First, we check their safety and soundness. We ensure that they're engaged in safe and sound behavior and that they're solvent. And second, we review their compliance with consumer regulations, as well as the Community Reinvestment Act. And the 9th Federal Reserve District includes Minnesota, Montana, North and South Dakota, the Upper Peninsula of Michigan, and the western portion of Wisconsin. With that, let me turn to the findings on the current condition of banks and where we think they're going. In general, it's a mixed message. Banking conditions remain weak by historical standards. That is, the asset quality of banks, how are their loans performing, their earnings, and their funding. Do they have access to stable funding? Those measures look relatively weak compared to where banks were at 10 years ago. On the positive side, however, there's been improvement in banking conditions. These same measures, asset quality, funding, and earnings, are either no longer getting worse during the year or have actually started to improve. So that's a summary of where banking conditions are. Where do we think they're going to be going in 2011? It's much of the same story. We see some improvement, but it's going to be slow, and I'll give you more details on that. With that, let me turn to some evidence on the banking conditions. First, we're going to look at asset quality. Again, that's looking at how loans are performing, and a standard measure of asset quality is looking at the loans that are not paying relative to the financial resources that banks have to absorb those losses. This chart provides a graph of that measure. It looks at both the median bank, that's the bank that's in the middle of the distribution, and the average of all banks in our district. And this data is as of 2010, the most current data that we have. And what you see when you look at a graph like this is that the this measure of loans that are not paying relative to resources to absorb them, remains at high levels compared to the last 10 years. But you will see that it has dipped in the last 3 or 4 quarters, suggesting an improvement. What drives this weak asset quality? It's commercial real estate. The next graph gives you the same ratio that I just showed you across many different loan types. And what you'll see is that the areas of the biggest band, the purple and the green in the graph, represent loans related to commercial real estate. The purple are loans to firms that are secured by commercial real estate, and the green are what are called construction and development loans. These are essentially funding of new projects, like a new subdivision of a housing project. And you'll see that those are the areas where the asset quality is both the weakest relative to the other loans, but has also shown improvement. So again, we see the same trend, historically relatively weak, but improvement over the last 3 or 4 quarters. Now let's turn to earnings. Earnings are just what they sound like. This is the profits that banks are earning. And here you're going to see the same trend. We'll remain at a level of return on assets, that's a standard measure of profitability, that is weak relative to what it was 10 years ago. But it has essentially stopped getting worse. It stopped declining. It's relatively flattened out. And that's true both, again, across the average and for the median institution. And I should say all the data I'm showing you are for the 9th District as a whole. If you looked at individual states, you would see some variation. And in particular, I would note that Montana is relatively weak compared to the rest of the district. Now let's turn where we're going to be heading in the future. My forecast is that we're going to see a continuation of the trends we've seen so far. That is improvement, but I think it's going to be at a relatively slow rate. So first, let me talk about why I see some improvement and then give you a sense of some of the headwinds that could make even slow improvement difficult to achieve. I think the main reason we're going to see improvement is for the same reason that in 2011, for the same reasons we've seen in 2010. And that's because asset quality is improving. Many of the bad loans that were made 3 or 4 years ago are finally rolling off the books of financial institutions in our district. And as a result, that will improve. And with improving asset quality, we should see improving earnings. So that's essentially why we would see the trend continuing. But it will be at a slow rate because it takes a long time for all of the weak loans to leave banks' books. Why might that not pan out? Why might we actually see less of an improvement? I think there's at least 2 reasons. One is if there is a shock to commercial real estate, that is if, for example, housing prices end up being weaker than we expect right now, that would show up with more commercial real estate loans, which are often related to housing, performing weaker than we expect. And I think we also are worried about a lack of demand for loans. Banks in the 9th Federal Reserve District make money by making loans. If there's a weak demand for loans, then they're going to make less money. And finally, I would say we are continuing to be focused on areas in which our banks are concentrated. And I've already mentioned commercial real estate, but a final area is agriculture. Now, this is a sector of the economy that's performing very well, particularly in the 9th Federal Reserve District. But nonetheless, we remain focused on it because with high prices, there's always the chance of declining prices. And given the number of banks in our district that are heavily exposed to agriculture, this will remain an area of concern, particularly around real estate for agricultural production. So let me sum up. We're seeing improvement in conditions, a welcome improvement, but it could be a slow road ahead of us. Thank you.